Welcome to Section 2 of the ASC 470 Debt Accounting Training Series for P&J Group. In this section, we answer two of the most practical questions in debt accounting. When exactly do you record a debt on the balance sheet, and what is the correct amount to record on day one? These questions sound straightforward. As you will see, the answers require careful attention to proceeds, fees, discounts, and the concept of carrying amount that we introduced in Section 1. By the end of this section, you will know exactly when each type of debt gets recorded, what goes into the initial carrying amount, and how to build the debt register entry from scratch. We will work through a full numerical example, a loan with both a discount and issuance costs, and trace the path from day one entry to the effective rate that will drive interest expense for the life of the loan. These are the mechanics that every reconciliation, every audit inquiry, and every disclosure starts from. Here is the key thing about debt recognition. It is not about signing a term sheet or receiving a credit approval. Debt goes on the balance sheet when two conditions are both met. There is a legal obligation to repay, and the entity has received economic value. In almost every case, that means the date the cash hits the bank account. Most people assume you record the face value of the loan, but that is not what happens. You record the proceeds, what you actually received. If the bank retained an origination fee at closing, you received less than the face amount, and that gap is a discount that flows through interest expense over the loan's life. The surprising part about term loans is how often companies record them at the wrong amount. The bank approves a facility for $1 million, and the accounting team records a $1 million liability on signing day. But the recognition event is the funding date, when cash arrives. And if the bank deducted $50,000 in origination fees before wiring the proceeds, the company actually received $950,000. The liability is still $1 million face value, but the initial carrying amount is $950,000. The $50,000 is a day one discount that raises the effective rate above the stated rate from the very first day. A bond issued at par is the cleanest case in debt accounting. The market rate equals the coupon rate, so investors pay exactly the face value. The proceeds equal the face value, there is no discount to amortize, and the coupon rate equals the effective rate, unless there are issuance costs. Watch out for this one. Even on a par issuance, if there are underwriting commissions or legal fees, those costs reduce the carrying amount below face value. So the effective rate is slightly higher than the coupon rate even at par. The carrying amount and face value diverge from day one, and the amortization process begins immediately. A discount bond is a company that agreed to pay investors more at maturity than it received at issuance. That gap is economic cost, the cost of offering a below-market coupon rate. Accounting requires that cost to be recognized over the bond's life, not just at maturity. So the discount is amortized as additional interest expense each period. The carrying amount starts below face value and climbs toward it, reaching face value exactly at maturity. The effective interest rate, which is what drives the amortization calculation, will always be higher than the coupon rate when a discount is present. The bigger the discount, the bigger the spread. A premium bond is the mirror image of a discount bond. Investors paid more than face value because the coupon rate is more attractive than the current market rate. That excess payment is economic benefit to the issuer. It effectively subsidizes future interest payments. The premium is amortized over the bond's life, reducing interest expense each period below the cash coupon paid. The carrying amount starts above face value and declines toward it at maturity. The effective rate will always be lower than the coupon rate when a premium exists. From a cash flow perspective, the company pays the same coupon. From an income statement perspective, the economic interest cost is lower. Here is where things get interesting. A non-interest-bearing note sounds like free money: borrow $1 million, repay $1 million, no interest. But accounting does not accept that story. If you borrow money today and repay the same amount in 3 years, The time value of money means you received less in economic terms than you will repay. Under a SC 83530, you must recognize the note at present value, the face amount discounted at an appropriate market rate for the credit quality and term. The difference between present value and face value is a discount, and it flows through interest expense over the life of the note. The effective cost of borrowing is always there. Accounting just makes it visible. Most debt involves cash, but not all of it. When a company issues a note to purchase equipment or settles a service obligation with a promissory note, the recognition and measurement rules still apply. The debt is recognized when the economic benefit, the equipment or the service, is received. The initial carrying amount is the fair value of what was received, or the present value of future payments if fair value is not readily available. The key test is always, which measure is more reliably determinable. The answer drives the initial carrying amount, and therefore the effective rate and amortization schedule for the entire life of the instrument. The carrying amount formula is the engine of debt accounting. Carrying amount equals face value minus unamortized discount minus unamortized issuance costs plus any unamortized premium. Every one of those components has a defined starting balance and a defined end balance of zero at maturity. The amortization schedule for each component is driven by the effective interest rate. The most important practice discipline this formula implies is reconciliation. At every reporting date, your debt register must be able to decompose the carrying amount into these four components. If you cannot verify the interest expense, the balance sheet line, or the maturity schedule. The formula is not just accounting theory, it is your audit trail. Let us make this concrete. P&J Group borrows $1 million. The bank issues the loan at 98, meaning the company receives $980,000 in proceeds. The bank and lawyers also charge $15,000 in issuance costs. So on day one, the balance sheet shows the loan at $965,000, not $1 million. The face value is $1 million. The carrying amount is $965,000. The gap of $35,000 is not a loss yet. It is a cost that will be recognized as additional interest expense over the life of the loan through the effective interest method. The effective rate will be higher than the stated coupon rate because the company received less than it will repay and also paid fees up front. The effective interest rate is calculated once, at inception, and used for the entire life of the debt. You solve for the rate that, when applied to the initial carrying amount, produces a present value equal to all future cash flows, the periodic interest payments, and the face value at maturity. In our example, the carrying amount is $965,000, but the company will ultimately repay $1 million in principal plus all the coupon payments. The internal rate of return on those cash flows, the effective rate, will be higher than the coupon rate. It is fixed permanently on day one. You cannot revise it later because you prefer a different number. This is a locked-in calculation that drives every subsequent interest expense entry. The Day 1 journal entry makes the carrying amount formula visible in the ledger. Cash is debited for $965,000, the actual proceeds. The discount and issuance cost contra accounts are debited for their respective amounts. Notes payable is credited for the full $1 million face value. On the balance sheet, the net presentation shows notes payable at face value with the contra accounts reducing it to $965,000. Over the loan's life, those contra account balances will be amortized to zero through periodic debit to interest expense. By maturity, the contra accounts are gone and the carrying amount equals face value. The entries are straightforward once you understand why each component exists. Let us close Section 2 with the essential points. Debt recognition is triggered by the combination of a legal obligation and receipt of economic benefit, almost always the funding date. Initial carrying amount is never simply the face value. It is the net of proceeds received, adjusted for any discount, issuance costs, and premium. Those adjustments are not cosmetic. They create the effective interest rate that drives every future period's interest expense calculation. Non-interest-bearing notes are a particularly important application. The absence of a stated rate does not mean the absence of economic interest, and the four-component reconciliation of your debt register is not optional. It is the foundation of every correct interest expense entry and every correct disclosure. Thank you for completing this section on recognition and initial measurement. Thank you for watching. Subscribe for more training from P&J Group.